Hi, my name's Sakeeb. I'm a co-founder at StrideUp. Sorry, it's a bit small, but so with the name of the event, it's worth thinking most of the big successes in fintech so far have been around user experience or delivery or pricing of traditional financial services. At StrideUp, we're working in the home finance sector, but we're really trying to question the nature of the underlying contract, the nature of how mortgages work. So I guess at a high level, that everyone knows there is a problem in housing, and we view that as a problem in home finance as well. So, house prices are expensive. There's been a multi-generational shift in asset prices, and mortgages haven't really kept up with this shift. The way things are done has been pretty much the same. So the result of this, well, there are lots of results. There's a lot of social issues coming about, but one way of measuring it, the proportion of people, young people renting has doubled in 10 years. There's an increasing divergence in wealth between the people who have already bought and making more money from property and the people who didn't buy and are stuck paying rent. So just to narrow in on the problem, everyone knows this. So mortgage finance, you save a deposit, you go to a bank, you get a mortgage, they lend you the money. Together with the deposit and the mortgage, you buy the property. The bank is lending you the money, so the first order risk in this is you, the borrower. It's a credit risk. So obviously, as you would expect, there are really stringent tests, size of deposit, and your loan to income multiple. Long story short, it will be very hard for you to get a mortgage above 4 to 4.5 times your income now. And I mean, the problem with that, obviously, is where can you find a property that is 4.5 times the average income, around 30,000 in London? Pretty much nowhere in the country does this work for average properties anymore, hence the affordability crisis. So not a solution, it's a really big problem, but we can help from a finance perspective. So the first thing we want to question is, why does it have to be all or nothing in terms of house ownership? Right now you have renting where you own nothing. You have buying with a mortgage, you own 100%. If you're a renter and you know in the future you want to buy a property, why can't you start by buying 10% today or 20% or whatever it is you can afford and gradually build up your stake? So what I'm describing is essentially equity financing. So we ditch the mortgage. The home buyer buys a portion of the property. The lender, in our case, is not really a lender, it's just people investing or financier investing in the property. The first order risk is now the property, it's not the creditor. And because of this, it's a lot more accessible. I'm out of time, so we can talk about the future over drinks, I guess.